How the government taxes and what the government then does with your taxes is one of the most important forces shaping the economy because it directly affects growth, jobs, and wages. A big question is, which approach actually works best to keep the economy growing? One belief is that cutting taxes for the wealthy is a way to boost growth by encouraging investment that trickles through the economy. But we now have more than 40 years of real-world evidence. From the Reagan tax cuts in 1981 to Kansas in 2013 to the Trump tax cuts in 2017 and the UK in 2022, the results are strikingly consistent. When growth showed up, it was driven mostly by borrowing, not by tax cuts paying for themselves. That kind of growth feels good at first, but it ends with higher debt and weaker fundamentals. Another misconception is that taxing the rich automatically harms the economy. Like dieting, moderation matters. Evidence shows that raising taxes on the top 10% has little effect on overall demand, while raising taxes on the other 90% has a large negative effect. The reason is simple. For high earners, a few percent less in a bank account barely changes spending. For lower earners, less money means fewer purchases of everyday goods and services. What really matters for growth is what happens next. Raising revenue from relatively idle money from top earners does nothing if it just sits there. The uncomfortable truth is that the lower someone's income, the faster an extra dollar gets spent. That spending becomes income for someone else, supporting jobs and pushing up real wages. Public investment in infrastructure delivers strong long-term benefits, but it has limited short-term impact. And using new revenue only to cut the deficit isn't very effective when the economy is short on demand, which the evidence suggests is the current problem. The most growth-oriented approach is straightforward. Raise taxes on the top 10%, use the revenue for a payroll tax cut for the middle, and increase direct payments to the lower 30% through existing programs. The irony is that the One Big Beautiful Bill does the opposite, favoring high earners while shrinking the safety net. Based on the evidence, that approach is the least likely to produce broad-based growth in the United States. Do you have thoughts on this or other approaches? Take a minute to leave a comment and read on.